We're going to be looking at chapters 3 and 4 this week, and we're going to be talking about the time value of money itself. I want to show you just a graphic here because it kind of helps you to understand what we're going to be talking about. Because cash, when it is invested, earns interest and accumulates. And over a long period of time, it can grow substantially because interest is earned on both the initial deposit and interest that's already been accumulated in the past. And you can calculate the amounts with a certain interest percentage assumptions. For example, you look at the graph here, and in year zero, if we were to make a deposit of $1,000 and we're going to assume an interest rate of 10%, and again, I know that 10% is not realistic for interest, but it helps just to kind of show the concept itself. Is you look at this and say, okay, that in year zero, that $1,000 at the end of year one is grown to $1,100, and then that interest and initial deposit of $1,100 by the end of year two grows to $1,210. And you can see that by the time we get to the year 10, it has grown to $2,594. Now you can actually calculate from in year zero by using a particular formula as to if you were to make an initial deposit of $1,000, what it would be in 10 years at 10% interest. Obviously, you could just calculate it year by year by year and just keep doing 10 calculations, or you can do one calculation using an interest rate factor. And the same way, you can also go backwards and you can say, okay, if I wanted to have in this example, if I wanted to have $2,594 in my account at year 10, assuming 10% interest, what do I need to put into the bank today in year zero to ensure that I have $2,594? And obviously, you can then calculate it in reverse and come up with the $1,000 itself. Now, there's also many other ways that you can calculate the time value, the present value, or the future value of money itself. But why would you be interested in going through these kind of gyrations? Well, there's a number of reasons. Obviously, the value of money is influenced by the time it is received. And the value of a given amount of money is generally greater the earlier it is received because of interest that you could earn on the money. And so that means the earlier you start saving, the more quickly your money can earn interest and grow. This can be applied to a single dollar amount, also called a lump sum, just like the slide that we looked at, or it can also be applied to an annuity. An annuity is just a series of payments that you receive in the future. For example, when we were looking at our slide before, it was just one lump sum of $1,000 we put into the savings. But let's say we were to put savings of $1,000 in the bank every single year. We could calculate what we would have by using future value formulas as to what we would have in 10 years with that equal annuity payment putting out into the future. Now, I'm not going to get into all of the details here as to actually how to do this conceptually because I've created a separate video. And in Moodle, I have that separate video out there where I've actually gone to a board and I've walked you through these calculations so you can see all of the various calculations. The most important thing to understand is the concepts behind the time value of money and how you approach that, because sometimes the equations themselves, when you look at them, you may feel like a deer in headlights, where you look at some of these equations and go, oh my gosh, I don't understand what in the world they're talking about. So I invite you, after we're done with this lecture, is for you to go and watch the other teaching video that will get kind of down and dirty into the actual calculations themselves. Now, I'd like to move on to chapter 4 and spend the remainder of our time really just talking about tax concepts themselves that you may use, especially when you're looking at planning a business itself. Now, we all understand that taxes are an integral part of our economy, that they're paid whether we're an individual or a business. They're paid on earned income. on consumer purchases sometimes through sales tax, wealth transfers when there's inheritance and estate taxes, and capital asset transactions, sometimes when there's an exchange of items. And there's also other special taxes out there that are just levied on alcohol and cigarettes and gasoline and all sorts of different ways that the government can find ways of in essence taking in additional income. Corporations obviously pay income taxes on their profits. Homeowners pay taxes, property taxes. Taxes overall are used to pay for government services and programs themselves. And most individuals, we pay taxes. We pay taxes at the federal level, at the state level in most states, and at local levels sometimes. Our federal tax system is administered by the Internal Revenue Service, and taxes are paid in several ways. Sometimes they're paid at the time of a transaction. Sometimes they're paid through payroll withholding. Sometimes they're paid by making quarterly estimated payments. For individuals, the tax years are obviously at December 31st, with our taxes to be filed and paid completely by April 15th. For corporations, especially small business corporations, most of them have also opted to stay on that kind of tax year where it ends on December 31st, just for the ease of recording and the ease of reporting. But you don't have to. A business can choose when they are actually put into place, whether it's incorporated or whenever they're organized, they can choose what tax year. For example, if they want to have a tax year that ends on June 30th and runs July 1st to June 30th, they can do so. Once they have made that election, it is difficult. It's not impossible, but it is difficult to change to a different tax year. Different businesses will have different cycles that they may have as the end of their tax year. For example, I used to work for Office Depot, and Office Depot, like many retailers, their end of their tax year and their end of their financial reporting year was actually the last Sunday in January. And you sit there and go, what? That is really weird. Why is that? Well, the reason for that is, just like most retailers, there's a lot of business that happens in the month of December. But because you're recognizing revenue in the month of December when you're doing the business, is you also want to have, for good accounting purposes, you want to recognize the allowances for returns on those sales. And because that can be very difficult to guesstimate, in essence, retailers will quite often say, well, we're going to have our cutoff through the month of January and assume that most of the sales that got returned most of the sales that were made in December got returned before the end of the month of January, so we have a much more accurate picture of what actually financially is our position themselves. And other kinds of businesses that may have different business cycles may opt for different years that they are operating on. But for our purposes, for most of the businesses that we are associated with, the small businesses, there's probably going to be December 31st. A government, some of you may actually work for the state, will be usually a June 30th. And that's just because of the way budget cycles run and how those budget cycles are approved and how they're spent and everything else. One tax that I want to mention just briefly, which is one that most of us are very familiar with, are Social Security taxes and Medicare taxes. And those things are paid on our earned income, our salary, or our wages. You'll hear sometimes the Social Security referred to as FICA, which just stands for Federal Insurance Contribution Act. And these are taxes that are paid to fund the Social Security system and the Medicare system. Medicare is a government health insurance program that covers people that are over the age of 65 and do not have health insurance, and it provides payments to healthcare providers in the case of illness. So what happens is FICA and Medicare are automatically withheld from our paychecks, and a certain percentage of 6.2% for Social Security and 1.45% for Medicare. And then those are withheld from our paycheck, and then our employer is required to match that. Now, obviously, that total amount that's paid in is 15.3% of our taxes. If we are self-employed, in other words, we're not receiving a regular paycheck, the government still has figured out that they want their money. So self-employed people must pay both sides of the equation. They must pay both the employee and the employer side. And so they're going to be paying in the 15.3% themselves into the system. Uh, as we start to go through here, I want to kind of walk us through income, and we're going to be using basic Form 1040 itself to really kind of understand the component pieces of income themselves. Personal income taxes are, of course, taxes that are imposed on the income that we earn. And so whether you file a 1040 or a 1040A or a 1040EZ, again, the filings just depending on how complicated your taxes are, what your income levels are, you may have a choice of being able to take simpler filings. But obviously the filings deadline for individuals is April 15th. You can do an extension past April 15th, but April 15th is when you are required to have all of your estimated taxes paid in. And as you go through here and you talk about the whole filing status as individuals, most of us are aware that there are different rates that are associated with the different statuses. So if you're filing single, there are different rates that are associated with single. Then there is a married filing joint, married filing separately, head of household, and there's even different rates for a qualifying widow or widower with a dependent child. So let's talk through the component pieces here. And I know for many of you, this is very basic, but for some of you, especially if you are a younger college student who may have not experienced these kinds of filings because you're still being incorporated as part of your parents' tax return, it's important to understand some of these basic concepts. First of all is just the income section itself. And there's what's called gross income. And gross income is all your reportable income from any source. And you can see on page 1 here that between 7 and all the way down through line 22, that is the income section of the portion of Form 1040. This will include your wages and salary, dividend income, interest income. That's interest that you've earned on your savings account. If you happen to have loaned people money and they're paying you interest, you would recognize that here. If you have bonds that you've invested in, that would be recognized here. All of these areas, and again, depending upon what the nature of the item is and what the dollar amount is, you may actually have to report some of those items on separate statements there. So you will see, for example, if you are receiving interest, there's a Schedule B that is required, and also dividends. You also can recognize that on Schedule B. And over on Schedule B, it'll then give you the dollar amounts that if you have interest above a certain dollar amount, you then have to report in detail where those interests came from. Schedule C, which is if you have your own little business and it's just being run as a sole proprietor, is you're going to be filling out a separate Schedule C and then bringing that net profit or net loss forward onto this statement here and entering that on the statement on line 12. On line 13, again, is for capital gains or losses, which is just this is what you earn or you lose when you sell an asset. And if hopefully you're investing, and we're talking about investment assets, not your personal assets like your TV or something like that. But if, for example, you made an investment in stock on the stock market and you sold it for a profit, which is hopefully what you did, you're going to be recognizing that there's a capital gain there, and you're going to be paying tax on that gain. And it's going to be dependent on your tax bracket, and it's also going to be dependent upon how long you held the underlying asset. If it was held for less than 12 months, that's what's considered a short-term capital gain. If it's more than 12 months, then that's a long-term capital gain, and there's different treatments for those items that will then give you certain tax benefits if they're longer term. Also, if you happen to have rental income or you're receiving royalties from partnerships or other things, there's Schedule E that you're going to record that on. If you happen to receive unemployment compensation itself, you still have to recognize that as taxable income. And then there's some other kinds of all sorts of miscellaneous kinds of things that may be income, and all of that then is reported here. And you're going to report all of that on your tax return from any source, and it's going to then summarize up on line number 22. Now, there's to that, there are those things that you're then going to adjust to gross income, and there are certain things that the feds allow you to deduct from there, and you can see those items there. And for most people, they do not have adjustments to gross income, but sometimes there are. For example, if there's unreimbursed business expense, that is the most common one that might be adjustable. You know, for example, let's say your employer asks you to go and let's say make pizza deliveries, and you are required to use your personal car, and they don't reimburse you for gas or any of those kinds of things. If you keep track of the mileage associated with that, then you may be recording your salary up above, and you're recording the tips that you may have gotten, but you can deduct from that down in adjusted gross income the cost of the gas that was out of your own pocket, and maybe even some of the wear and tear on your car that you incurred by using a mileage allowance. So in essence, you don't have to get socked for that which has cost you to earn that income. After you make those adjustments, of course, you're going to go down to adjusted gross income down at the bottom of line 37. And then down at the bottom of 37, and we'll go to the back of that page, which is page 2, you're then going to be doing adjustments to that adjusted gross income. And what you're really going to be doing is in essence deducting from that certain deductions and exemptions which are allowed. And for every person, there is a standard deduction, which is just a fixed amount that can be adjusted from your gross income to determine your taxable income. Again, the standard deduction is not affected by income. So whether you make $50,000 or you make $5,000, you still get the same standard deduction allowed by category there. It's affected by your filing status, and it may also be affected by your age. And this is something that the IRS periodically adjusts to keep pace with inflation. So let's look at what some of those deductions are. We're going to be looking at what's called Schedule A. And what Schedule A is, it really is a detail of detailed deductions that you can take. And we call them itemized deductions. These are specific expenses that can be deducted to reduce your taxable income. And obviously you can see certain items here. There's medical expenses that you can take, which if they're in excess of 10% of your adjusted gross income, you can deduct approved medical and dental expenses. There's taxes that you paid, which are real estate taxes, and there's certain personal property taxes. If you pay state taxes, those can be here affected here, and you can deduct those from your gross income. And state income tax, again, just depends upon whether you live in a state that has income taxes or not. Also, interest that you paid. These are interest that's paid on borrowed money, primarily your interest on your mortgage, but there's also some other kinds of interest that you can deduct from that. Your charitable contributions or gifts to charity. Again, these things have certain limitations on it, but any sort of gifts that you give in cash, which is the best kind, or by check because you have a trail of it. But if you also give like clothes or things like that, you're allowed to recognize that gift and the fair value of that gift. There's a casualty and theft losses, and there's all sorts of different rules associated with that as to whether or not those are deductible. Tax preparation fees, other kinds of expenses. There's just all sorts of little miscellaneous expenses that are out there that are deductible. And so you add all of those things up as an individual, and you come up with a total of your itemized deductions. And if your itemized deductions in total exceed what your standard deduction is, then you are allowed to recognize whichever one is the greater, whether your standard deduction or the total of your itemized deductions. And you take that over what your total is over on Schedule A, and you're allowed to recognize your personal exemptions and your exemptions that you may have for, and we'll go back to just page 2 here to see this, to really determine what the total exemptions are and how that impacts your taxable income. Your taxable income portion is going to be the adjusted gross income less your deductions and your exemptions, and you see that in line 43. There's also other taxes that can come into play, and there's also some other credits that can come into play. And now the difference between a tax deduction and a tax credit is this. Tax credits are better. Tax credits basically allow you to reduce your taxes dollar for dollar. So if you have an income credit, you have a renter's credit, you have any of those kinds of things, is every dollar of credit you can reduce the taxes you owe by $1. A deduction is going to be, you're only reducing your taxable income, but not the actual taxes itself. So let's say you're in a 20% tax bracket. That means for every deduction that you have of $1, you basically are reducing your taxes by 20 cents or 20% on that. So if you have a choice between a deduction or a credit, it's always better to have a credit than a deduction itself. So you work your way down, and you're going to determine your tax liability based upon your filing status and and whatever your tax percentage is off of the tables themselves. You'll be reducing that by your tax credits, and you get down to the bottom line, which is amount you're going to be refunded or amount you're going to be owed. Now, one of the things that I do want to mention here with respect to taxes itself is sometimes people fall into this mindset that, well, it's always better to owe a whole bunch of money at the end of the year. But the government has figured out that how to get around that by, in essence, living off of their money is if you underreport the amount of taxes that you pay, then there is an underpayment penalty that can kick into play. And there's we won't get into all the calculations for that, but in essence, if it's something that you underpay every single year, then they'll start to penalize you for that. Where if this year you just got caught short because you just had an exception, you had more income than what you thought, or you underheld the reporting, you can basically bypass the penalty for this year. But if it repeats next year, then you may get penalized. So the reason that we talk a lot about tax planning itself and just the importance of tax planning is really key tax planning decisions are an integral part of building your financial plan, whether as an individual or as a business, because you want to understand what tax savings are currently available to you, how your decisions may increase your tax liabilities or savings in the future, how it may impact your withholding on the individual side, or if you have a business and have to pay in estimated taxes on a monthly or quarterly basis, how it may impact that, and really what records you should be keeping. Because obviously you know that if there are certain kinds of expenses that you may be able to take advantage of from a tax standpoint, you want to be sure that you have adequate records that you're keeping to back up whatever that amount. Next week we'll be starting on chapter 5.